Welcome everyone to my YouTube channel. As promised, today I'm making this video to share with you my results of testing 3 strategies in July. So I tested these strategies live. If you go back to my July videos, you can see them happening live. And after 1 month of placing trades, I just wanted to share with you what the outcome was and compare strategies and give you some pros and cons. But before we get to the results, I'll just quickly show you what the idea behind each strategy is and give you an example so you have a better understanding of it, and then we'll get to the result part. So the first strategy I tested in July was a hedging support and resistance zone strategy. As you can see on the screen, so hedging, as opposed to placing stop loss and take profit orders, involves placing 2 trades opposite of one another, same size. And what that does is, let's say if you're going for a sell, you sell 1 lot, and 50 pip away from that sell you place a buy in case price comes back. And if the price goes up and hits that buy, then you'll be in 2 positions at the same time. You'll be in a sell for 1 lot, you'll be in a buy for 1 lot, and the price difference between them is 50 pips. So from there, no matter where the price will go, your loss is fixed at 50 pips. It's a lot like hitting stop loss, except that you're not taking out of the trade. You're still in the trade, but 2 equally opposite positions. That gives you the opportunity to manage your losses better. Now let's have a look at some example things can happen here. I apologize for my drawings, but try to pay attention to the content. So what happened here is, first we need to draw some support resistance zone, and these are the zones where price has bounced strongly previously. So for example, on the left, price has come up to this zone, bounce strongly down. So that would make this zone up here support resistance zone. So once a price comes to that zone again, you place a trade. Now you place a sell with the idea that it's gonna bounce again, right? Because it's a resistance zone. Whether you place a sell beforehand using a pending order, or whether you wait for the price come to that level, stop, and then place a sell, monitor it, see if it's bouncing, then place a sell. That's different methods you can apply. We don't get into that. That's really personal preference. So say I put a pending order here, price came up, hit my sell, and when I put a sell order, at the same time I'm gonna put a buy order just above that zone. So what this buy order does with the same size as the sell order, it fixes my loss in the distance between these two. So if the distance is 50 pips, now if the price comes up, hit my buy order, I'll be in 2 positions, 1 sell, 1 buy, with a price difference of 50 pips. So from there, regardless of price going up or down, my loss is fixed at 50 pips. We need to do this because sometimes price can move very quickly, it can just jump up very quickly, and they can take you out and you can lose all the money in your account. What this does is same as a stop loss. It fixes your loss without closing your positions. This way you're in 2 positions at the same time. So in this scenario, let's say we do a sell, right? If the price bounces and go down, that's just like normal trade. It's in your direction, you wait for it, you can close it whenever you want, right? Now if price comes back up, like in this situation, hits the buy, and different things can happen. If the price comes back up, hits a buy, you're in 2 positions. You're in a 1 sell position, which is losing at the moment, and in a buy position. If the price pulls back to your zone again, what you can do, you can close the sell position, which was losing, because at the zone that sell position is at break even. So the idea here is when the price breaks out, pulls back, that shows a sign of breakout and retest. So this is another aspect of using zones. So at a zone, price can bounce, and if it doesn't bounce, it breaks the zone, it comes back to it, that shows a sign of breakout retest, right? Assuming that the price comes back here, we would expect a retest for a continuation up, right? So we close the sell, keep the buy open. Now in this position, you can add another buy, right? Once you add another buy, you need to put hedge order to account for these two buys that you have. So once you enter another buy, you need to account for these two buys using two hedge orders, which will be located below the zone, right? That way, always you account for any position that you have open with the pending opposite positions on the other side of a zone. That way, if the price whips back down below, you're protected and your loss would be limited to only the distance, the price difference between these two. So these two are pending orders sell, right? Which in this case, it hasn't triggered. So in this case, price breaks out, pulls back, and takes off. And once it reaches up there, you can close your buy. And assuming this is another zone here from a previous level, you can enter another sell and then wait for a price to pull back and repeat. So that's the one situation. Another situation would be when the price breaks out, hits your buy hedge order, and if it doesn't come back, it just goes to the next zone. What you can do is that you can wait for the price to reach next zone, close your winning buy. Now you still have a losing sell to manage. In here, we managed it when the price came back. We managed it to zero loss. On the other hand, here, price didn't come back, so it went to another zone. So what you can do, you close the buy in profit, you enter another sell, expecting a bounce. And then when the price bounces, and if the price bounces halfway between these two zones, you can close the winning sell and close the losing sell at break even. So the total of 3 trades, you have one winner, and these two sells cancel each other out. So the total of 3 trades, and the basket of these trades, you make profit. So that's a different scenario. Now, next scenario would be if the price fakes out, hits your buy hedge, and then breaks back in and continues down. So what happens here when the price breaks out, fakes out, comes back in, you need to wait for the price to return to the zone. Now, this is also another breakout and retest, right? So when it breaks out and retests on the downside, you would expect a move down, right? So you keep your sell open, and when the price comes back, you close the buy position. And when the retest happens, you can either enter a second position, or you can just go with the original, leave the original sell open, and just continue with one position and take profit. On the other hand, also with this strategy, it can get really messy, especially if the zone is not very well defined. So price can fake out to the upside, come back down, fake out to the downside, and just go sideways for a while before choosing one direction. During this situation, the best is, so you're going to be in a sell and you're going to be in a buy hedge. So no matter which side price choose to go, your loss is only limited between the price difference between these two. So during this situation, you basically assess the momentum of the market, right? For example, here, if the price comes down and instead of bouncing here, it breaks through, then you can close this buy and then wait to see if it bounces from the bottom, similar to this position. Then if it doesn't and looks like it's breaking up, you can close your sell and enter another buy for a continuation up. And this is the complexity of this method, which can happen. So simple formations would be previously when these moves happens, when you have a simple breakout retest continuation, or you have just a break and continuation and then a bounce at a different zone. And these here become more complicated situations. So that's the hedging strategy. Now this gives you opportunity to manage. As you can see, you can manage your open positions differently. If you just simply go with a stop loss, every time you enter, you'll be stopped out, and then you have to enter a new position. So that's one strategy I tested. Now, another strategy was Tim's 15-minute strategy. Now, this is very similar to a support resistance strategy. Actually uses daily support and resistance zone, but it works on a lower time frame. So what this strategy is, simply you need to draw support resistance zone on a daily, right? And then move to a 15 minutes time frame. It doesn't have to be 15 minutes. It's just the lower time frame that gives you more definition and more detail about the price move. So on the lower time frame, you want to see price making in clear trend. Clear trend would be a higher highs followed by lower highs continuously into the zone. So instead of an impulse move down or an impulse move up, you have clear trend into the zone, and that gives you the opportunity to wait for a bounce. So when the price on the 15 minutes time frame reaches up here and then it drops, if it breaks the previous structure, it's no longer an uptrend, right? So it's very important. It needs to break the previous structure in an uptrend. That would be the previous higher low. Once it breaks that, it's potentially no longer in that uptrend. So you can have a higher probability of a bounce down. So then you can wait for a new higher low to be made that shows a sign of a downtrend forming, and then you can go for a sell, usually 1 to 2 or 1 to 3. So that's the Tim's 15 minutes strategy. All right. Now, third strategy I tested is my own strategy. I call it momentum candle strategy. It's very simple. I also use support resistance zones, but not always. This is mostly basically focuses on strong candles being made and follow through of those strong candles. So just some examples here. Every time there's a strong candle compared to previously made candle, for example this red candle, I would basically enter at the open of the next candle, my stop loss behind the previous candle, and take profit 1 to 1. Now the advantage of this method is that as long as a continuous move is being made, you can keep entering every day and make money. It doesn't require you to wait for the price to be at a zone for it to bounce. There is no bounce involved. It's based on the continuous move. So here, for example, we can see we have a strong bullish candle being made with a strong wick, a strong body. And then you can enter at the open of new candle, put your stop behind the body or wick of the previous candle, depending on the size, and go for a 1 to 1. Now, obviously, just like any other strategy, doesn't always work, but it's very simple. And you can, at the same time, you can take into account support and resistance zones. Make sure that you're not, even though you get a strong candle, you don't actually trade into these zones. Okay, so this is my momentum candle strategy. Now let's go have a look at some examples for the hedging strategy and for the Tim's strategy. For hedging strategy, I'm just going to show you this as an example. Of course, price is already passed and I can tell where the zones are. Much easier said than done than live, but this is just to give you a understanding of the concept. And remember, you should always back test and live test before going with any strategy, because some strategy that works for one person might not work for the other. It's highly dependent on your intuition and dependent on your own psychology and your own characteristics as well. Anyway, let's continue here. Let's have a look. For example, we have a zone made here where price broke and retested and bounced very strongly. When the price is coming up here, if I put a pending order here and price bounces down, this is just simple a bounce off the zone, right? The hedge goes above, and in this case, the hedge is not triggered. So after it's moved, you can close your hedge since you don't need it. So if the price comes down here, also another zone, what you want to do, you want to close the position, close your winning position, and then enter a buy. Remember, our first priority is always to expect a bounce of a zone. It might happen 50% of the times, happens 50% of times, doesn't happen. When it happens, we just make a simple profit. If it doesn't happen, we manage it with the hedging. That's the idea. So in this case, for example, we put a buy here for a bounce up, but that didn't happen, right? And our hedge is located right below the zone, right? So now when the price hits the pending buy and then comes down, hits the pending sell of the same size, now we're in two positions, the opposite and equal sizes. So our loss is basically maintained to this range. This is the loss we have, which in this case would be 20 pips since I'm on a 4 hour. You can do this on different time frames. Now we need to manage these two positions now. So what happens? Price goes down. When we're here, we don't know if price is gonna bounce up here. There is no zone to the left. So price comes down, pulls back up to our surprise, and then when it gets up to here, we see that it's struggling to go. So what this shows that since this is a previous zone, we would expect, also always say priority is to always expect a bounce, right? We would expect a bounce down. That means we close the buy at a small loss, we keep the sell open because we expect a bounce. So this way we've managed the losing buy to 0 loss, and we keep the sell open. Once it goes down back to this zone, and then we can close the sell in profit. And then here we enter another buy, right? It's at the zone and we expect a bounce. Now this one, depending on your strategy, you can close it whenever you want. I'm just assuming we close at the next zone. Now in here, it didn't reach the next zone, so we didn't close it on time, and then price comes back, right? So price comes back, and we have a hedge that's always placed under the zone. Price comes back, breaks through, hits the hedge. Now we're in two positions again. So in this case, price goes back up, right? Again, we expect a bounce, right? So we expect a breakout, retest, and a bounce down. What we do, price comes back up, we expect a bounce down, we close the buy at a small loss, and we keep the sell open. When you have the sell open, every time you have one position open, you always need to create a hedge order opposite to it to always restrict your loss. So once we close this buy, we need to put another buy above the zone to account for this open sell. Yeah. So in this case, bad luck, and price, instead of bouncing down, it breaks up. Now we have these two positions open. So what do? What we do, we just wait for the price reach another zone. In this case, price comes to this zone, we close the buy, we enter another sell. When we enter another sell, and in this case, we have one losing position, another sell position. You have two sell position open. We need to put two pending buy above these two positions beyond the zone to limit our risk. Yeah. So these are pending buys, each accounting for one of these sells. So we're lucky in this case, and the price bounces down, right? When price bounces down, we wait for the price to reach halfway between these two sells, and then we can close both. Once you close that, this upper sell is in profit, lower sell is in loss. So upper sell in profit, lower sell is in a loss, and we already taken profit on this buy. So on the basket of these three trades, we have a one winning buy, and these two sells cancel each other out. So the basket of three trades gives us a win. Yeah. So that's how you manage hedge position. And then you can get rid of these pending hedges, and you continue the same way. So this is just an example of how you trade hedging strategy. All right, for the 15 minutes teams strategy, here you can see I've drawn on a daily chart two zones. One zone down bottom here, another zone up there where the price has bounced beforehand. So let's assume we're here, right? Obviously this is done, it's just a perfect example to show you the concept, and it doesn't always work like that. You can see from the live result what the outcome is for this strategy. But the idea is when the price makes clear higher highs and higher lows into a zone, and then it comes back, it breaks the previous structure down and it creates a lower high. That's when you know that basically in confluence with this zone, price is shifting direction. That's the idea behind Tim's 15 minutes strategy. So break off this trend, break off a structure. At this point, this trend no longer applies, right? Because the previous structure is broken, and then you come back with a lower high that shows a potential for a new downtrend to be formed, and then you just enter simply on the way down. Very, very simple. This doesn't apply to when the price spikes up and it spikes down. Tim's strategy only applies with a clear trend being made into a support and resistance zone. You can apply the similar thing to here. You can see lower highs, lower lows being made, and the previous structure broken. So if this is the previous structure, or this is the previous structure, that really depends on your own intuition, and then you can enter a position here. And in this case, you can see that the method hasn't worked, right? Even though it started to bounce here, but it didn't, and it went sideways. So it's not always a winning strategy. There is no such a thing. All right, so that's the explanation of that one. Now, my own strategy, I want to explain it. You can already see it on my other videos. And let's go to the results, see what we achieved during July testing. All right, so for the hedging strategy, I've listed all the 28 pairs, and because we don't have a stop loss and take profit, I can't really measure this based on risk reward. The way I've measured it is based on winners and losers, where I've taken profit based on pips. So these are pip values basically. So this is for July. You can see during this time we've placed different trades. Some pairs have had more trades, some less, and I've placed total of 39 trades on a daily chart, and I've ended up the total together 3,165 pips. If you trade $1 per pip, you end up with $3,165 for this month, right? So that's the result. Overall, it's a difficult strategy, so just give you my own thoughts on it. It's a good strategy. It's difficult to do, and it's very difficult to manage. So that's one of the cons. It's very hard to know where prices bounces, even though you have zones. Price sometimes does a lot of fake outs or doesn't respect certain zones, and so it's kind of hard to know where to put the pending orders and that kind of thing. And what happens if price breaks this one zone and then goes to the next zone and then breaks that zone? At every stage, you get into more and more hedges, right? Because hedging actually forces you to open multiple positions. So you have a sell and a buy hedge, you're in two open positions. It's not like a stop loss that takes you out. So every time it breaks a zone, it goes to a next zone. You also need to create more hedge, and that basically messes up with your available margin. So what I've realized, and I've done this in the past, I've lost about, I think, $500 trying the hedging strategy, and I've realized that even with the account, which is 500 leverage account, I've realized that I run out of margin very quickly. Because if you're trading 28 pairs and each one takes two position, and that would be a total of 56 position, and if each one of them starts breaking zones, and then you need to double up on position, so your two position becomes four positions, and then four positions become 8 positions before you can manage them. Because to manage them, you need to wait for the price to bounce, come back down, so you can close your losses at a smaller loss, right? That's the whole idea. And that can you can easily get a margin call. So that's the issue I had with the hedging strategy. It's good if you're only trading 1 or 2 pairs, but for 28 pairs, I wouldn't recommend trading too many pairs with it. And the complexity of it is also quite high. Now, teams strategy, it didn't perform very well for me. So this is based on risk. So 1R, minus 1R, 2R. And I ended up at the end, I ended up with 28 trades, and I ended up with minus 3R for the month. So if your risk is $100 a trade, you'll be losing $300. Now the issue I found with teams strategy is very rarely you find price move in a nice clear trend into a zone. So usually when daily starts moving, daily candles form moves into a zone, they move very aggressively, and on the lower time frame that translates into spikes. So you can have 15-minute chart spiking very quickly up, then it's pulling back deep and then going sideways for a little bit, and then basically that means you won't have a lot of opportunity to enter on this method. And when you do, I found that just because it breaks the previous structure of a trend, it doesn't mean it would bounce down. It can still pull back, stop you out before continuing down or even breaking up. So break of a lower time frame trend for a higher time frame bounce, it's let's just say it didn't work out very well for me. You can test it out yourself. Now, my strategies, as I explained, it's very simple. So I either, so when I win 1R. When I lose 1R. And when I can manage at 0 or 1.5, that's when I'm able to set an alert and price comes back and I close it early. Yeah. So I've done this more detailed because I found that the results are better on my strategy. So all in all here, that's the trades I've done daily. So you can expect a very high number of trades. So this method is good if on every trade you wanna risk small amounts. So you can't go risking $1,000 risk per trade because one day you might have 18 trades, and on average I've had about 10 trades on average on a daily basis here. And the total count 184 trades in the month, and these are wins, total wins and losses in R for different pairs. And obviously I've had some losers as well, some depending on the month, depending on market condition. Some pairs behave better than others. Now all in all, I've added all up. So first week I ended up with 26R profit, and second week I ended up with 25R profit, third week 23R profit, and the final week wasn't very good because I realized, so minus 9R loss here, I realized during this week, the final week of July, prices started consolidating. So I ended up with momentum candle that had no follow through. So I got momentum candles, but they just flipped back and turned around very quickly, or didn't reach a TP and then came back and hit the stop loss quickly. So that's a lot. So the total for the month was 66R, which is, compared to the other method, is very amazing for July. Now I've started actually trading with real capital. So the testing phase is over. That was July. I just did test trades, but now I'm risking around $20, 20 AUD per trade for August. The way I've seen it, price is still in consolidation mostly. It hasn't really moved much, so I'm not getting these kind of returns yet. I'm more, not as bad as this, but I'm around this ballpark. Hopefully when the price picks up, that's where this method really shines, when the movements are aggressive and there's a lot of follow through in the market. Yeah, so that's the result of God, as I promised. of giving you pros and cons of every strategy. Hopefully you've learned something. I give you some good ideas for your own methods. Maybe you can go back test them, live test them, and get some ideas. All right, thank you guys for watching, and if you like these videos, subscribe. And I have daily trade videos that I do live as well. And if you want any content I cover, let me know in the comments, and I can do some back testing. I can show you live testing for those strategies and other things as well. Hopefully, as we keep going, all of us can improve in our trading and become consistently profitable. Cheers.